Partnered by Times Influence.
It's been 5 years since Voyage Navigate 2018 first set sail. Be it choppy waters or stormy weather, this platform has helped investors and distributors alike understand market movements and global trends. Hello and welcome to Aditya Birla Sun Life Mutual Fund presents Voyage Navigate 2018 powered by ET Now, an initiative that brings thought leaders, industry experts and market movers together to share their expertise in maneuvering today's volatile global markets. Let's dive into the conclave. Voyage Navigate 2018 by Aditya Birla Sun Life Mutual Funds AMC brought the change makers of today to guide investors and distributors for a better tomorrow. With over 2,000 participants, the 5th edition of Voyage Navigate aimed at empowering distribution partners, institutional investors and individuals to make more informed investment decisions across changing market conditions.
The idea really is to understand the pulse of India here. We had something what could be called as a impediment of long-term taxation. Markets last year were good, but this year markets have been volatile. Upar niche nifty ho raha hai. So, uska impact, what has been the impact of that on the market, on the behavior of investors, what patterns are visible, what essentially on-ground activities indicating. So we just thought we'll do a mood check. So let's start with Ashish on my immediate right to get a sense on what Delhi wale kya kar rahe. Post the announcement of long-term capital tax, suddenly 10% aapko tax dena padega. Every mutual fund distributor would say, boss, mutual fund mein dalo tax to dena hi nahi padta. Is that pitch now changing?
So definitely the effort has been more now with this taxation. I think it could have been, wish list could have been delayed a little further and it could have got the indexation. The real point is why we are not getting the indexation. The conversation is little not easy as it was earlier. But the people who have really made the returns and tasted the success of equity investing, they are not concerned. It is only the first time investors or people who have come in recent past are more concerned.
What has been your experience in terms of investor feedback in this year because of market volatility and because of the imposition of long terms?
Last couple of years, we have seen a buoyancy from investors wanting to come into equities, come into mutual funds. And largely our job has been to put their expectations right and tell them that this is not a quick money game. So we have been trying to moderate their entry into the market. We also at a time of setting the expectations, we would talk that if the market is at 10,000 Nifty today, what will you do at 9,000? And many of them would not have an idea that the market can go down 10%. We tried to tell them that this is a long-term asset. You have to look at a 5-year period. You have to look at a goal-oriented way of investing. So you, in the build-out period, you build your investments over a period of time. And for a particular goal, if you are investing, then even this long-term capital gains tax which has come, it does not hit you till you redeem your investments. So you get the advantage of pre-tax compounding. And so this is an asset class where you will put 5-year, 7-year, 10-year money, hold it for a longer period, so defer your taxes A.
But have you got any sense that the collections which you mobilize every month,
right,
usme kuch, has it dropped, has it gone higher? Is the general interest towards equity still strong?
It's largely been neutral for us. Okay. The reason is many people find this asset allocation approach very boring. So the people who want quick results may not come to us in the first place. So possibly, but we have not seen any great reduction in the money that we get month on month.
चलिए अब जमशेदपुर की बात करते हैं.
This long-term capital gain tax has introduced, but this is not much effect on the investor, as the people, those who are investing 20 to 30 lakhs rupees, they are not affected by this. Mostly the retired people are putting money in balance fund to take out monthly withdrawal as systematic withdrawal plan. In the case of systematic withdrawal fund, I think from next 5 years, as all previous assets had converted into assets as on 31st January 2018. So next 5 years, if we are going to take 25 or 30,000 rupees per month, they need not to pay any tax on that. At 1 lakh rupees tax, capital gain is tax free. Even though if you are they supposed to pay tax, they are in lower tax bracket. So they may get some tax exemption of the no tax limit also. The people, those high net worth individuals, they are in 30% tax bracket. So they are not afraid of paying 10% tax. They are very happy that we will get here 10 to 12% return and we have to pay only 10% tax here. So they are happy with even this introduction of capital gain tax. So no difference in getting money. No redemption is there for this capital gain tax. So people are comfortable, and I am also comfortable.
Tell us a bit about yourself, the geography you represent.
As LTCG is being discussed, and you were talking about redemption. So see, there is a difference between risk taking and risk tolerance. When new investor comes in, he sees the past 1 year return and he thinks I can take that risk and I can also generate this kind of a return. But for an advisor, for the investor, the risk tolerance is more important than the risk-taking ability. Because risk tolerance says you are pessimist. Risk-taking says you are optimist. So when I am optimist, I am seeing the higher return. But when I am pessimist, I am seeing the downside of my capital. So those investors, those who have entered in this 1 year period or 1.5 year period, and those who are expecting one year return of 15-20%, they might have gone for redemptions. However, these kind of investors I'm not handling. I'm handling 3 years, 5 years kind of long-term investors. So we have not seen any kind of redemptions there.
Wonderful. What has been the experience in Jaipur?
Change of asset class, liquidity, and volatility of market. Happening of events every day, either tweets, either Korean missile test, each and everything. ये opportunities हैं, क्योंकि equity market एक long term story है. हम इसको day to day watch करके नहीं देख सकते कि 2018 में क्या होने वाला है या 2017 में क्या हुआ. जो भी events हैं, ये opportunities हैं. 2018 भी मैं नहीं मानता, कुछ थीम्स हैं जो बहुत अच्छी लग रही हैं. इंडिया स्टोरी इंटैक्ट है. मे बी पॉसिबल ग्लोबली काफ़ी फैक्टर्स ऐसे चल रहे हैं कि जिसकी वजह से थीम बहुत जल्दी चेंज हो रही हैं, इंटरेस्ट रेट हाइक हो रहे हैं. बट आई डोंट थिंक इक्विटी मार्केट के लिए अगर 3-5 साल की हॉरिजन से हम सोचें तो कोई बहुत बड़ा नेगेटिव है. मैं एक्सपेक्ट करता हूँ 2018 में भी अच्छे इन्वेस्टमेंट्स 2 डिजिट्स में रिटर्न देंगे, जो कि मोर देन डेट के रिटर्न है.
सर, आपका किस तरह का क्लाइंट बेस है, द ज्योग्राफी विच यू आर प्रेजेंट?
ये 2017 में इतना बुलिश मार्केट था, 2018 में कैसे रिटर्न बना. 2017 में मैंने सब क्लाइंट को लमसम इन्वेस्टमेंट कराया.
2017 में?
हाँ, 16-17 में. अभी मैं क्लाइंट को बोल रहा हूँ, यदि आपको स्टॉक मार्केट में और म्यूचुअल फंड में पैसा बनाना है तो SIP इज़ द बेस्ट टूल. और SIP में क्या है कि फर्स्ट ईयर इट बिहेव लाइक ए इक्विटी फंड, सेकंड ईयर इट विल बिहेव लाइक ए बैलेंस फंड, थर्ड ईयर इट विल बिहेव लाइक MIP, एंड फोर्थ ईयर इट विल बिहेव लाइक डेब्ट फंड. देयर इज नो रिस्क आफ्टर 4 ईयर. तो जिसको कंजर्वेटिव इन्वेस्टर है उसको इक्विटी में SIP कराइए, कोई प्रॉब्लम नहीं है. तो अभी तो वही SIP में ज़्यादा फोकस कर रहे हैं.
तो अग्रेसिव को क्या करा रहे हैं?
और एग्रेसिव जो है उसको लार्ज कैप फंड दे रहे हैं या बैलेंस फंड थोड़ा बहुत दे रहे हैं. बैलेंस फंड बहुत हो गया, लार्ज कैप फंड ज़्यादा बेटर है.
सर,
So typically, if you look at the corporate clients, most of them are debt investors. They have very clear agenda of getting a certain percentage of interest with a certain risk profile they have. As far as the larger HNIs are concerned, I mean, we typically go through the complete process of risk profiling, analytics, the asset allocation. I would not change my asset allocation just because 2017 was very exciting and 2018 is likely to be bad and choppy. So we stick to asset allocation, have a strategic allocation based on the profile of the client, and have a tactical call depending on how you want to. Like if you ask me for this year, what do you want to do? Probably have a little more bias towards a large cap or a multi cap. So that's the way I look at it. I'm not going to change the asset allocation just because a year has been exciting or otherwise. But I think a long-term capital gain is surely not a reason for the markets to go down. It's just an excuse to begin with. I don't think anybody likes to pay tax, surely not Indians. So that's a given thing. So having said that, nobody's taken out money because you just had a long-term capital gain on this. Also, that little charm of equity, especially when it doesn't do too well, is lost because if you're giving 11% on equity or 10% on equity and you're paying 10% tax and you have a debt product which gives you 8.5, and you get to index it, suddenly debt looks equally good. So if you get your asset allocation right, I don't think you need redemptions.
Fair point. I'm good that unlike the perception what we at least had in media that long-term taxation will have a lot of impact on flows, the reality is very different. I think that is the messaging which I want to first send across, that we may assume that long-term की वजह से बहुत बड़ा redemption and asset allocation change आ रहा है, but the reality is very, very different. And this something should be a very important takeaway that yes, long-term is something which is going to make your returns lower, but it is not forcing investors to say, oh my God, I will not buy stocks and mutual funds, right?
So are we seeing any panic or are we seeing any redemptions because of this short burst of volatility? The answer is a clear no. The essence of this, I would say, is that before you take any investment into any asset class, we go through a proper round of investor education. If we are successful in that education, and if we are holding their hands in these phases, there's no panic. That is very clear. And that is why our friend Ashish would say, advisor zaruri hai. Before we take on risk assessment, education are a must, Nikunj.
It's time for a very short break, but don't go anywhere. We'll be right back here on Voyage Navigate 2018. Welcome back. You're watching Aditya Birla Sun Life Mutual Fund presents Voyage Navigate 2018 powered by ET Now. Now next up we have Member of Parliament Dr. Subramanian Swamy, who shares his thoughts on India's economic policies and the roadmap ahead. Take a look.
One of the poorly recognized facts is that there are many things that we inherited which we did not speak about in 2014. The classic case is that of the NPAs of the banks, where earlier on there were hardly any fixed rules. It was ad hoc, and by the time in 2014 we woke up to it, it was already a huge problem. The NPA situation of today cannot be traced to any policy decisions of this present government. Of course, that's not an excuse. We were elected to rectify things, so it's assumed that it was bad. The growth rate had been declining from 2008 in GDP, and for the first year, 2014-15, and also 2015-16, the growth rate had increased, and then this decline has taken place since then. We have had 3 years of declines, or projected declines, and right now I would say, after applying my mind to my knowledge of the GDP, the growth rate should be today about 6%. World Bank and other agencies are predicting that we will grow at 7.3, 7.5, etc. But these predictions mean nothing because nobody remembers what they predicted when the time comes. I would say that even if we achieved in this coming financial year, 2018-19, a 7.5% growth rate as the World Bank's prediction yesterday is correct, that's not sufficient. What we need now is a 10+% growth rate. And it is possible. If you say that 7.5% growth rate is not enough for clearing the backlog of unemployment, for bringing about a reduction in poverty. Then what is that minimum growth rate? According to me, it is 10%. Even more than 10% is even better. But if it is 10%, how are you going to achieve it? Well, technical economics tells us that the growth rate is the ratio of the rate of savings divided by the capital output ratio. Capital output ratio measures the efficiency in the use of capital. Our country today, it is 4.3, 4.4, which means about 4, if you invest 4.4 rupees in capital, then you will get in perpetuity 1 rupee per year in perpetuity. And that's very high compared to other countries. At one stage, Japan had 2.8. 3 is normal. If India were to get 3.5, say 3.5, and a rate of investment as 35% of GDP, that 35% of GDP divided by 3.5 will give you 10%. So that rule of thumb is the one that indicates to you how much you have to save. Our household savings is the largest in the world. No other country saves from the household as much as any other country. Our country, you will find that household savings is almost 29% of the GDP. Then you add corporate savings and so on. We were running at 36, 37% till all these recent events came. And now the rate of savings has also gone down. Foreign investment has never been more than 1 or 2%. And I don't think we should think of foreign investment as a panacea. And we have to be very careful that there's a level playing field. We expect the economy to be much improved by the end of this year, not in substantive terms, but for substantive changes, the next 5 years would become very important. And finally, the economic program, which is good for the nature of the Indian people. The nature of the Indian people is decentralization. They don't want to be directed by anybody. The Indian, by nature, loves his freedom, and that you must empower. If you do that, you will have a great India in another 10 years. Thank you very much.
That was Dr. Subramanian Swamy setting the tone for India's economic growth. When we return, venture capitalist Sameer Arora takes the stage. Don't go anywhere, we'll be right back. Welcome back to Voyage Navigate 2018. Sameer Arora of Helios Capital shares his thoughts on ways to stay afloat in today's cutthroat environment. Let's take a look.
India is obscene in its volatility. In its positive months, the market went up 202 times, but lost 98.5% when the negative months were over. This is actual data. This is not my theory. The actual data is that whatever you made in the positive months, you were left with less than 2% of that when the negative months were over, although the months were all mixed with each other. The point is, if you could be down 97% instead of 98%, you will be, instead of, or on the other side, you'll have to be, instead of going up 200 times, you'll have to go up 300 times for the same return. So look at it like this. 1 becomes 200 and 200 becomes 4. Although this is not happening together and that is not happening together. If I fall 1% less, I fall 97%, so my return becomes 6. If you say I'll buy small cap and I'll buy mid cap and I'll buy infrastructure, so you will fall the same. But if you want to go to 6, that means your 200 has to be 300. Because you know that whatever you do in the positive months, after the negative months are over, you will be left with only 2%. That is in dollar. And in rupee terms, it's a little more distinguished. So it falls some 95%. whoever did well in the negative months basically did better than the guys who did well in the positive months because of the fact that it falls so much. If you fall a little less, it gets magnified. That is why maybe the Indian MNC stocks do well. If you see, they don't go up a lot, but they fall less in bad markets. And at the end of the year, without realizing that in which month did they do well, they have suddenly outperformed. And then we have this one fellow in Singapore who's quite a nice guy. And if you see his fund, which is a long-short fund, they were up only 33 out of 85 and still beat everybody, basically because it falls less. He's a good guy. You can even take a selfie with him later. But the point is that the issue was of falling less, not of going up more. There is no value in our market. I mean, there is value of going up more, but then you should fall less on the other side is the real value. Now, somebody could say that this is because of 2008. And mostly, it won't be obviously one for one. But basically, if you fell less, you outperformed. The going up and no value. Look here. These guys were up only 33 times out of 94 and still beat everybody because of falling less in the negative months. This will not happen in every market. And this will not happen with every long-short fund in the sense that the way the Indian long-short guys are selling their funds, they are making it look as if you should get debt-type return from a long-short fund. This has to be viewed that it will fall when it falls, but it will fall a little less than the long-only guys, and that is much more value in compounding when you have lots of negative months, and when the negative months, it falls a lot. So we strongly believe. Now, how does it help? For example, last year, this fund was losing a lot of money on the shorts. But because these fellows know that this market falls a lot, it is a matter of time. So in the first 3 months, everything got recovered because that is the nature of our market. Our market is very volatile, and one day maybe it will become less volatile, but if it happens, then that also people can learn. But right now, it is very crucial to save money. So therefore, the idea should be to aim for only reasonable return, because the game is high conviction in reasonable return so that you lose less, so that you compound better. And that changes what you should own. You don't have to own a sugar stock or some metal stock because, oh my God, it'll go up. Because it'll fall also a lot when it falls. And you can do it for any period, long period. You can't do it for 1 or 2 years. But if you do it for 8, 10 years, it nearly always comes out that losing less is very powerful to make returns. So investing is not complicated. Basically, all it needs is buy stocks when they sell for less than they are worth. It's very easy. Now, of course, some of you who are a little bit more inquisitive will say that how to know what they are worth. Now, that's actually very complicated. Thank you very much.
And that brings us to the end of the 5th edition of Aditya Birla Sun Life Mutual Fund presents Voyage Navigate 2018, powered by ET Now. As we draw the curtains on this season, we hope that this event has helped you get a better understanding of the opportunities and the challenges in the Indian financial markets. From the entire team, many thanks for watching.
Partnered by Times Influence.